Good day overall for the Bears. We had a rally on the open. The rally was decent for the Bulls, consecutive bull bars, but then we had a fairly big bear bar that was climactic, testing above yesterday's high. With 3 consecutive bull bars, it's reasonable to think that the odds favored a second leg up, which they did. However, the Bears, they ended up getting a bear reversal bar on 4. That's a strong enough reversal bar. Odds are we're going to get some kind of second leg down. I still think we'll probably test back up to the 3 close at a minimum. And then bar 5, we have a high 1 buy, good for the Bulls. Increases the odds we get a second leg up. However, disappointed Bulls at the 3 close, that increases the risk there might be more traders selling above the 5 high. And then 6, we have a second leg down for the Bears, good for the Bears, but possible 2-legged pullback, test the breakout point on bar at the 2 high. With the market being high in the trading range, there's increased risk that the Bears get a second leg down and test of the open of the day in the low of bar 1. One of the problems for the Bulls on the open was this right here. We had a spike in channel and then a late bull breakout. That was a climactic bull bar late in the bull trend, and that increased the probability that the market was going to find more sellers on the open than buyers. With 6 and 7 consecutive bear bars, that's a strong enough breakout that the odds are we're going to get a second leg down. And it looks like you may have always in bears giving up below bar 6. And then we have 3 consecutive bear bars, 6, 7, and 8. That's a strong enough bear breakout. And the odds are we'll probably get a second leg down, and the market's probably going to fall below the bar 2 low. So this is good for the Bears. 3 consecutive bear bars, probably going to go at least a little bit lower. And then 9, we have a 4th consecutive bear bar, always in short, breaking out below the low of the day. Good for the Bears. I suspect a trading range is most likely. We'll probably try and get a bounce, but not a lot of bulls probably are willing to buy after this many bars down. And then 10, we have a bear breakout below 9. That's good for the Bears. With the selling pressure from the high of the day, bar 4, down to the 10 low, odds are the first reversal up is probably going to be minor. And then 11, we have a bull bar. It's an inside bar, but a tail above the bar. Probably sellers above, scaling in higher. But the Bulls, Bears may not come in until the midpoint of the sell-off from the high of the day to the low of 10. 12, doji, tail above and tail below. Not a great sell below bar 12, but not a great buy above bar 12 either. And then 13, we tried to break to the upside, but we have a tail on the bar. That increases the odds that we're going to get some kind of second leg to the downside. But with 3 consecutive bull bars, probably buyers near the 13 low. 14, bear bar, but tail below the bar. Probably not going a lot lower. We may just end up going sideways here. But I suspect a second leg down and a test of the 10 close at a minimum. And then 15, we got a surprise. 15, strong enough bear bar. Probably going to get at least a second leg down, and we may test down to the 81 close. Follow through, 16, that's good for the Bears. Probably going to go at least a little bit lower. And I suspect probably sellers above. But it's reasonable to assume after 2 legs down, sell off, pause, second leg, that we may get some kind of bounce. We tried to break to the upside above 16, but we found sellers, and then we reversed down on 17. 17, low 1 short, good for the Bears. There might initially be buyers below the bar, but I suspect with the market forming a low 1, such as 17, I suspect that there's going to be sellers in the upper third of the bar at the minimum, so really not ideal. And then 18, strong enough breakout and a surprise. Even though it's consecutive sell climaxes, the market formed a sell-off, pause, second leg down, and the second leg is subdivided into 2 legs down. That increases the risk that we're going to get a pullback. So selling the close of 18, stop above 18, it's really not all that ideal. However, because the sell-off down from 18 is pretty strong, the odds are bears selling 18 and selling more on a bounce are probably going to make money here. So really not ideal. You can buy, but, well, let me say it differently. We're probably going to get a bounce, but I suspect the reversal up's minor, so traders selling and scaling in are probably going to make money. 19, we have a doji, and that confirms my opinion. 18, weak follow through, 19, probably going to bounce. but enough selling pressure that I think the reality is the first reversal up's probably going to be minor. And then 20, we have a pretty strong bull reversal bar. That's a strong enough bar that we may go a little bit higher. But if you're buying above 20, stop below 19, it's not that great of a trade. It's not as great as it appears. And then 21, we have a follow through bar, but look what happened on 21. We have a tail below the bar. And because of that, it's possible that 20 and 21, even though it's 2 consecutive bull bars and that's good for the bulls, it's also a small 2-legged rally on a smaller time frame. And if you include 19, it could be a parabolic wedge. The market went down on 19 and up on 19, down on 20, up on 20, up on bar 20, down on 21, up on 21. So if you reverse down on 22, it's basically a parabolic wedge on a smaller time frame. 22, bear bar closing on its low after the sell-off to 19. That's good for the bears. Probably going to test back down to the 19 close. We may not go straight down after 20 because of the consecutive bull bars. However, I suspect the odds are we're going to at least go a little bit lower. And then 22 and 23 consecutive bear bars. That's strong enough that the odds are we're going to get some kind of second leg down. So that's good for the bears. 24, we have a bear bar for follow through. The follow through is a little bit weak after 22 and 23, but I suspect after 3 consecutive bear bars, probably the first reversal up is going to be minor. 24, bull bar, but not a great buy after the 3 consecutive bear bars. So probably we may get a small second leg up after 25, but I suspect minor reversal up. Then we got a second leg down on 26. 26, not a great buy above, not a great sell below either. So we may end up going mostly sideways here. And then 27 broke to the downside. That's good for the bears, but you can see we're starting to form a channel, and 25 is the best looking bear bar in the past series of bars, so we may end up getting a bounce here. 26 bull bar, but tail above the bar, not a great buy above, so we may end up going sideways. And you can see that's basically what happened for the next several bars. We ended up forming a tight trading range, and the market entered breakout mode. With this much buying pressure, I thought it was reasonable for the market to try and stabilize and test up to the 21 close. And then we kept trying to break to the upside. The market tried to reverse down 39 with a bear bar, but not a great sell. Probably buyers not far below, and the bulls got a decent bull bar on 40. 40, strong enough bar, may go a little bit higher. And then 41, we have a reversal and follow through. 40, 41, that's good for the bulls. Increase the odds we get a second leg up, but still inside the tight trading range, not ideal. And then 42, bear bar. What about selling the close of 42? I would not. If anything, I think there's more buyers below 42 rather than sellers. And then we got a small second leg down, 43, and we reversed up on 43 at the same time. 43, we have basically a second entry buy, double bottom with 40. Low probability buy, but it's reasonable betting that we're going to test back up to 41 and that we might break above the tight trading range to test up to the 21 high. 45, 3 consecutive bull bars, 43, 44, 45, good for the bulls, but a lot of overlap with 44 and 45. And that makes me think we may end up just going more sideways here. 46 doji, not a great buy for the bulls, not a great sell for the bears either. So I suspect we'll probably get some kind of second leg. And instead, we started to form the micro channel, 47, 48, 49. 49, reasonable to think buyers below, but middle of a tight trading range, 4 bar bear micro channel, lowers the probability for the bears. Lowers the probability for the bulls, but overall, and pretty much 50-50, maybe slightly favors the bears in testing to a new low, but really not ideal. And then we got the doji on 50. 50, bull doji bar, not a great buy for the bulls. But I suspect, if anything, I think we're going to attempt to try and break out above the 46 high. And then 51, we got a small second leg down after the 3 consecutive bear bars here. Not a great buy above, but not a great sell below. And then we got the surprise on 52. Strong enough surprise, we may get a small second leg down, but I suspect buyers around where we are. 53, not a great buy for the bulls. Not a great buy, but bad follow through after the bear breakout 52. So I suspect bears who sold the close at 52, disappointed 53, probably will buy back their shorts on 54. And 54, low one short, not a great sell, probably going to bounce. And then we tried to bounce 55. And then 56, 57, but we're forming. We're alternating bull bars and dojis. So a possible parabolic wedge. Rally, pause, rally. Not great. The bulls, they need the upside breakout above the moving average. And then we got the outside bar, 58. 58, it's good for the bears, but it's an outside bar. Not great context. There might be more traders buying below it. And then 59, we have a follow-through bar, but you really want to be selling at the bottom of this range? Probably not. 58 tested the low of 52, and that's the close of 52, so a perfect double bottom. And then the market reversed up on 60. 60, strong enough bull reversal bar, increases the odds that we're going to get some kind of second leg up, so that's good for the bulls. 60, 61, consecutive bull bars. I suspect we're probably going to get some kind of second leg up in test of the 46 high. And then we got a doji, and then a small overlapping bar, and a small overlapping bar. 60 and 61, you can think about it as a spike, and then 62, 63, 64 as a channel. But we're losing momentum and energy for the bulls, so we may end up having to pull back here. 65, doji, not great for the bulls buying above, not great for the bears selling below either. But because of the trading range price action, and we have two legs up near the top of the range, we may test back down and close breakout points. 66, not a great high one buy. There might be more traders selling above, not a great sell below either. And then we got follow through 67. We may get a small second leg down after 66 and 67, but I think tough to do much of anything here. And then the bull bar, 68, not a great buy above. 69, we have a doji, low one short, probably buyers below, but tough to buy when the market's in a tight trading range with small bars. And then 70, doji, not a great buy above, not a great sell below. Bears are hopeful that we get a second leg down, 66, 67, and we test the 52 low. And then we got the surprise on 71 with follow through 72. And that led to a sell-off into basically a weak sell-off and a second leg down to the 75 low. And then the market pretty much went sideways for the rest of the day. Overall, fairly good selling for the bears. I think it was tough to do. It looks easy, but the reality is you get a sell, you have a rally here and then a sell-off sideways, big second leg down, and then two consecutive big bull bars. It's hard to sell down here, and you can see what happened. Look at the close of 23. Look how much the market touched the 23 close. We went sideways for several hours here, broke out to the downside for one bar, and then went back to sideways trading. But realistically, it's basically a limit order market after bar 23. You had some instances where you could buy or sell, but it really wasn't that easy. Daily chart, as far as next week, the market's still trying to break to the downside, but with all this overlapping bars and overlapping behavior, I suspect even if we fall below 6,600 and the November 2025 lows, I suspect buyers below. So if I do anything down here, I suspect bulls are buying, scaling in lower. You can see weekly chart. You really want to be selling down here? Probably not. Probably more traders buying in this location rather than selling. For stop orders, I thought you could buy above 2, and then bears, they could probably sell below 4, or they can wait and sell below 6, 7, 8, or 9, and then probably a minor reversal up, so not a great buy. And then bears, do they get out above 20? They can, and if they do, they probably get short again below 22 or 23. And then I think bears, I'd get out above any bull bar in here. And then what about selling below bars? I think that's tough. Not a great sell, 39. Not a great buy. Not a great buy above 40. And then more or less the same all through here. Not a great sell, 42. Maybe you buy above 44, but not ideal. Middle of a tight trading range. And then I thought it was a reasonable buy above 60. But if you do, you probably get out after consecutive bear bars. Limit orders, probably buyers below 1. I thought probably sellers above 10, scaling and higher. And then I thought sellers above 16. And then probably buyers below these bars, scaling and lower. I thought buyers below 36, buyers below 39 if you're aggressive. Buyers below 43, probably ideal. buyers below 57, buyers below 58, anywhere in here, betting on a bounce and a test of the 46 high. And then I thought sellers above 68, but probably buyers below 69, so fairly tough. And then at this point, I think it's tough to sell the close of 72, but you could argue sellers above 72 because of the follow through after 71. Buy the close, sell the close, probably sell the close 7, 8, 9, probably okay for a second leg down. Sell the close 15, 16, 17, probably okay. Even sell the close 23, 24, especially if you can use a wide stop scale in. And that's probably it for buy the close, sell the close. Maybe buy the close 61, 62, but pretty aggressive, not great risk reward on the trade. So really not ideal. Let me take a look at questions. Okay, question, Brad. Bulls buying for swing have been failing for 3 days now. The spike of context, bear wedge keeps selling. What to look for in an actual bull reversal? Well, every one of these are bull reversals. And, I'm assuming you're talking about the 5-minute chart. But, the reality is, once the market starts to go sideways here, you have bulls buying above 40, and then the market goes up and starts to reverse down. They exit buying above 44, and the market starts to go sideways. Some of those bulls exit. This is minor. And then we had a second leg down, and we had bar 60. I thought that was a more credible buy. Bulls buying there. What do they do when they see the small bars? They exit. Most major trend reversals are minor reversals, and therefore, you keep hoping for the reversal, but expecting trading range price action. That was a good example. And then as far as, higher time frames, you can see this is basically the higher time frame. We've been channeling down in a type bear channel. But part of my problem with the argument, this is my issue with the argument for the bears. Do you really want to be selling down here? Probably not. If anything, there's probably more buyers down here. So what do I think is going to happen next week? I think we're probably going to test all the way back up to the March highs. Probably easier to see on a daily chart. I think bears are buying. I think bulls will buy in this general location, and that will increase the odds that we'll test back up here. So that is my overall concern. You ever get concerned about fundamentals and geopolitical tensions? Yeah, there's always things that can happen. Obviously, the tension in the Middle East. But the reality is, for me, I try and stick to just the price action. And, obviously, you have, quote unquote, overnight risk or weekend risk holding things. But the reality is, I try and keep it relatively simple. And when you're trading, try not to trade during the FOMC event. Avoid that. And then other than that, put a stop in the market and just hope for the best. But the reality is there's always going to be something, geopolitical, fundamental. If you think about it, we've had, obviously 2020, we had COVID. And then a couple of years later, you have Ukraine. And now we have the Middle East. There's always going to be something geopolitical that's screwed up in the world. And, I hear it all the time. There's always you can attribute everything. Then the market's going to do this because of that. Or something happened in India or Japan, so the market's going to do this. But the reality is, I think if you think that way, you're just never going to take a trade. So for me, I really just do my best to just focus on the price action and just try and think through structuring trades where the math makes sense, where the risk reward makes sense. And if I can do that, then I'm at peace with it. Do you think that AI will change how trading works? Or do you think it'll just be the same? I think it's really just going to be the same. All AI is doing is, you have obviously machine learning and all these things going on. But the reality is price action is still going to be driven by smart institutions on both sides of the trade. Nobody's going to be able to gang up and dominate one side, because the reality is, if the market, there has to be a statistical edge for both sides. There's got to be a profitable trader's equation. If you think about it, if there's no reason for the bulls to buy If there's no reason for traders to buy as the market's going down, the market is going to collapse to a price level where nobody's going to sell and everybody's going to buy. If the market's rallying, forming a rally, and there's no reason for traders to sell, the market is going to quickly race up to a price level where traders are going to start selling again. The reality is, there's so much volume on both sides that in order for liquidity to be tight and the bid-ask spread to be tight, you have to have traders playing both sides, and they have to have a reason to take the trade. One side's always going to have risk reward. The other side's always going to have better probability, and it's going to flip-flop back and forth. So no, I think price action can become more precise, but it's already really precise. And the reality is, if you're trading a 5-minute chart, it's still going to take 5 minutes for the bar to close. Yes, you may have price discovery quicker and moves happen faster, but the reality is you're going to see it on a chart. So if anything, I do not think it's going to significantly change price action. Because to significantly change price action, if you think about it, what would change of the price action? The only thing that there has to be both sides. Both sides have to have a reasonable method. To answer your question, no, I do not think AI is going to significantly change price action. So where do we go tomorrow? I think overall, or Monday, I guess, because obviously it's a weekend. I think next week we're probably going to bounce. We have consecutive bear bars, 3 consecutive bear bars, overlapping bars, relatively big bar today with overlap. Even if we test down to 6,600, I suspect buyers where we are. Think about it. But point is, if market's at 6,600, the reality is there's going to be bulls buying, willing to scale in lower. Look what happened the last time we touched 6,600. We touched it and bounced. What do you think is going to happen down here? Probably going to touch it, probably going to bounce. Okay, thanks everyone for listening, and I hope everyone has a great weekend.